Well, we're going to talk about one theme now where I think there's been a fair bit of excitement. It's a sector which has not done very well if you take, say, the last 3-4 years. Although I think the fortunes looked like they were starting to change a little bit for a bit. There was a flicker of hope. Life insurance is what I'm talking about. So much regulatory change which has been proposed. Some of it has happened. The latest, of course, is what the IRDAI, the regulator, is proposing in terms of surrender charges, which insurance companies are allowed to charge their policy holders. Now, this is a proposal. It's a consultation paper. Sources tell CNBC-TV18, and we put the story out yesterday, that in response to the consultation paper, insurers want IRDAI to extend the time by which they can submit the feedback on the proposals till the 31st of Jan. The earlier date was 3rd of January. Yash is here with the latest, but also a bit of context in terms of why this issue is important. And then we'll get into a discussion with some experts. Yash, take it away.
Well, Prashant, the last 2 weeks we've been discussing everything, right, in terms of how the higher surrender value proposed by the regulator will be calculated. And of course, the sum and substance is that this particular proposal is beneficial for policyholders since it gets them a higher surrender value when a policy is terminated on a voluntary basis. But it's negative for life insurance companies because they get to retain, far less in terms of the surrender charges which they charge to these policyholders surrendering their policy. The difference is significant, and I'll just give you two numbers to help you understand what kind of significant difference does it make. Policyholders are expected to get 50% higher in terms of surrender value to what they receive now. And life insurance companies will get to retain just 1/3 of what they retain currently in terms of surrender charges. Now, since the last 2 weeks, there have been various developments on this one. There are concerns raised by life insurance companies. They've written to the IRDAI chairman to seek a meeting to express those concerns. But largely, the concerns are that this will lead to an asset liability mismatch because the pricing happens in a certain way. Also, they feel that this will bring a drop in the industry persistency levels. As far as some of the suggestions which life insurance companies want to put forth as far as the regulators concerned, life insurance companies are saying that they feel that higher surrender value should be given on short-term policies and not on long-term policies because short-term are closer to maturity by the time they surrender. Same is not the case with long-term. Also, they seek the threshold limit to be a percentage of the premium, charged to the policyholder and what they've received. IRDAI, according to our sources, is not in favor of giving them that threshold limit as the percentage of the premium paid. Rather, the regulator feels that it should be the expenses which the life insurance company has made on a particular policy, plus some bit of nominal charges. That is the threshold which IRDAI sees. The same is not the case with life insurance companies.
All right, Yash, thank you very much for that. Well, let's take this discussion forward. We have, an expert in the field, on the subject of personal finance, actually, the author of a book which needs little by way of introduction. Let's Talk Money. Monika Halan is joining us now. Monika, good morning. Great to have you with us here. Thanks very much. We have Nilesh Sathe, who is the former member of IRDAI, also with us. Mr. Sathe, thank you very much for joining us from a vacation. Really thankful.
Thank you very much.
Thank you, sir. Monika, if I can start with you, I mean, how do you look at it? You heard Yash explain, we've been on top of the story, since this was first put out. Is this going to be disruptive? Is it going to get diluted as you see it? What's your sense? Great for consumers, of course, policyholders, of course, if it goes through as what the regulator is proposing.
Right. So I want to put it in context. How would you react if a fixed deposit, a 5-year fixed deposit, if you exited after 1 year, gave you nothing back? You've put 1 lakh in a fixed deposit and for 5 years, but you exit after a year and you get 0 back. And after 3 years, you get 1/3 back, right? So life insurance policies on the traditional side are akin to deposits with a life cover attached to it. I have not for decades been able to understand why investor gouging happens when policyholders surrender too early. So if a person puts in 1 lakh and doesn't pay the second premium, today she loses all her money. After 5 premiums, if she doesn't pay the 6th premium, she gets out of 5 lakh only 2.5 lakh back. right? So this is what I call the product is constructed like a trap with very high first-year commissions. IRDA has now allowed insurance companies to fix their commission levels. Sometimes it can go as high as 100%. So the first year entire premium is going as commission, and then the commissions are dropping to 7.5% in subsequent years. So the agents hard sell this product. And then because the companies make profits out of surrender values, investors are almost nudged and encouraged to surrender their policies early. You must know that the persistency is 44% today on the 5th-year persistency, which means more than half the policyholders, less than half the policyholders take home half their money after 5 years, right? So you're getting less than half your money for more than half of the people who hold the policy. So the product is built like a trap. I am not sure why IRDA is treating the industry with such kid gloves. It needs to write a regulation. It can't say, here, I'm opening the locker door and you can decide whether you want to stay or go. So allowing the industry to fix their own surrender values is very surprising to me, that the regulator, when it's trying to solve this problem of investor gouging, is allowing the industry to do that. So that's my short point, that, IRDA, write a regulation. Why are you afraid of the industry? Are you an industry association or are you a regulator?
No, but they, to be fair, Monica, they are trying to correct it, aren't they? They're doing something about it now.
But they're saying, okay, here is a way ahead. You decide how much you want to give back. Now, which company, when you're booking profits on this horrible surrender value profits, remember, it's the blood, sweat, and tears of policyholders which are being booked as profits on early surrender. Which insurance company is going to be fair? I mean, it's not an industry which has covered itself in glory on investor interest. So you are handing the baton to them.
Yeah. No, I get that, and absolutely points taken. Mr. Sathe is also with us, someone who's been on the policy-making side. Mr. Sathe, you heard Monica. What's your first thoughts, sir, on the subject?
The first is there is a difference between a bank fixed deposit or a mutual fund and insurance. In case of insurance, it's a group of people who get insured, and out of that, certain percentage of people do die in the first year or the first day of taking the policy as well. And for them, the amount of money that is to be paid back by the insurance companies is much more than the premium which is paid by them. Where from insurance companies will generate this money? They will take this money out of the lucky ones who are surviving over a period of time. So in the first year, this mortality premium, which is in case of traditional plans, which is being prescribed, actually that is certainly on the mortality amount which is going out of the premium that is paid by the surviving ones will have to be recovered by the insurance companies. This is not like a fixed deposit. This is a basic difference. This is one part. I'm not here to, only talk about the regulator or the policy or the insurance companies. Understanding the rationale between it. We have seen that insurance is a long-term product. It is not a 5-year fixed deposit. Even in case of mutual funds, we have seen that the SIPs lapse after 3 years, most of the SIPs. And insurance being a long-term product, it is necessary that policy should continue for a long term. And for that, this is one of the arresting measure that the policy should continue for a longer period of time. This is one part. As far as profitability is concerned, over a period of time, IRDA has been looking at how surrender values can be increased. They have done it. In the past, LIC only used to give 30% of the premiums paid other than the first year as surrender value on 3 years completion. It has been now increased substantially. As Monica also has said, it comes to 50% at the end of 5 years plus bonus, which she has not taken into account. 35% of bonus will also be added to it. Anyway, that apart, what I mean to say is, one, whether IRDA should look into it, I say yes. Policyholders must keep on getting higher amounts as IRDA should prescribe it. If at all IRDA finds that this is adding to the profits of the company, IRDA should restrict it. But in the process, insurance companies should not be made to incur losses. This is one part. which again the regulator also has to see. So this is one more point which I wanted to bring about, that let us not keep comparing the products, whether it is fixed deposit or a mutual fund or insurance companies or all financial products, and whosoever wants to invest in that product should invest. Whether insurance should be looked as investment avenue, answer is no. Why is it that people are investing in non-profit or participating policies? They should not invest. This is something which we should promote. Insurance is a unique product which gives huge amount of money on death, which no other investment avenue gives. So it should be invested only for that purpose. So this is something which should be promoted. And I personally feel that the step of IRDA is indirectly in this direction, that why do you invest in with profit policies or with bonus policies when insurance should be taken only for the purpose of coverage of risk on life. And if this is understood, you are getting less surrender value. Okay, fine. So don't invest. You have
Mr.
to look at
Sathe,
insurance only from insurance point of view. Do that. And that is something which everybody of us should keep promoting.
absolutely, Mr. Sathe, we couldn't agree more with you. And I think a lot of the pure play financial, planners, educators, people like Monika, a lot of the experts we call on the channel as well. I mean, I have never met anybody who says, look at investments through insurance. Each one of our guests always says that, cover yourself with pure term insurance and look at investments separately. But then, that's a much bigger conversation for another day. The point is that maybe it's not intentional. The products are not designed to generate more profit, but perhaps, even there are unintended consequences. And what's happening, as Monika said, with the commission structure, if you have commissions so high in the first year, the mutual fund industry, for instance, moved to the trail commission model, right, where commissions are paid out for investors continuing to be in the product. Perhaps along with higher surrender value charges, is there a need to look at maybe the commission structure? I mean, how can we ensure that investors do manage to surrender the policies that they don't like anymore or don't find useful anymore, and get an adequate amount of money back?
Yeah, if you are asking this question to me, let me reply. One is, no 100% commission is paid by anybody on any product. The first year entire amount goes for commission is absolutely a myth. This is one part. The initial expenses are high. Stamp duty is to be paid. Whether bank fixed deposit pays stamp duty or whether mutual fund pays such a high stamp duty on insurance policy is at 20 paisa per 1,000 sum assured, which is atrocious. GST at 18% is atrocious. Of course, GST doesn't come in picture at this point of time, but this is something which we should talk about, leaving it apart. The mutual fund product gives you commission based on the NAV. NAV keeps on going up. But in case of insurance product, which is a ULIP product, it is a fixed amount of commission that is paid because it is based on premium, and the premium doesn't go up. So there is a variation. See, what I mean is every product is different. If all products are identical, then why is it that people will take different products? Every product has a different flair. So those who like it will buy it.
I think you make your point, strongly, Mr. Sathe. Let me give an opportunity to Monika to come in as well and to respond to some of what you said. Monika, go on.
Look, when Mr. Sathe is saying that a person buys a policy and he dies next year, where is the money going to come from? Now, I'm really surprised, being member of member like IRDAI, he's making such a basic error. The whole mortality premium is designed by actuaries for exactly that point. So there is two parts of the insurance premium. There's a mortality part and there's an investment part. The investment part is 90% of the entire premium. The mortality part is less than 10%. And that mortality part is aimed to take care of deaths midway through the policy. So I just don't understand this argument that, the people have to be paid, therefore there have to be high surrender values. That's insurance 101, and I'm very surprised to hear that. Second is that here you when you're comparing a product, you have to see its function and not its form. What is the function of a traditional insurance policy? What are the products they buy? They buy basically government bonds. So what does an insurance policy do? It buys an 8% government bond and it gives the investor 2 to 3%. So this is one, in its essence, it's value destruction. Two, you are penalizing a policyholder who has been hounded by an agent, who's been lied to by the banking relationship manager to buy this product, which they say is a very high return product. And if you realize your mistake any time after the first premium, you suffer huge losses. So my point remains that it's built like a trap. And just the fact that the insurance companies listed on the market are suffering losses just on a draft which is consultative, which points in the direction of investors getting a fairer deal. If insurance companies' stock prices are falling, I mean, what other evidence do you need that these profits are built on the tears of policyholders who have just had their money gouged out? You know, I feel very passionately about this because not many people understand the technicals of insurance. When you understand it, you are aghast at the open robbing of policyholder that has been going on in the country for decades. So that's my short point, that this is an industry built on the blood and tears of policyholders, and it shows up in the profits of insurance companies, which are now suffering because IRDA has dared to put out a very mild draft. That's my short point.
We take this point, and I reckon this will require a slightly longer chat than the 15 minutes we've spent on the subject. But, we leave it here for now. Thank you very much, Monika, for passionately making your case. Mrs. Sathe, for strongly putting forward your point as well. We'll have both of you back and others as well to continue to debate and discuss this important issue in the insurance space. Thank you very much. And Mrs. Sathe, please do enjoy your the remainder of your holidays. And thank you for joining us. Thank you. We'll take a very quick commercial break here. Markets up